With innovation that never decays,
Oracle helps customers see data in new ways. The company isn't just another software giant. It has evolved into a formidable force in cloud computing, AI-driven enterprise solutions, and integrated hardware.
howdy y'all, my name is Tanish Muralidhar.
And my name is Gabriel Melo. We are from Rouse High School in Texas, home to Oracle.
Today, we present our buy recommendation for Oracle Corporation, ticker symbol ORCL, with a price target of $213.75, which represents a 51.25% upside in the next 12 months.
Founded in 1977, Oracle has grown into an international technology powerhouse. The company operates in four key segments, including cloud services and license support, encompassing Oracle Cloud Infrastructure, software as a service, and platform as a service, cloud and on-premise licensing, hosting Oracle's comprehensive software solutions, hardware, where the company provides Oracle engineered servers and storage systems, and services, which include consulting and customer support to enhance software performance. With a strong presence in enterprise technology, Oracle serves over 430,000 customers in 175 countries, backing 97% of Fortune 500 companies' database and cloud computing needs.
This has enabled Oracle to outperform the S&P 500 by 111% over the past 5 years, and we believe this trend will continue. Our baseline growth scenarios indicate revenue and EBITDA growth that far exceeds that of the S&P 500 while offering a reasonable valuation. Beyond past performance, Oracle is rapidly expanding in the cloud computing and enterprise software market. The global cloud computing industry, valued at over $300 billion, is expected to grow at a CAGR of 17.9% over the next 5 years.
Although Oracle holds only a 3% market share, its cloud segment is growing at an impressive 51% year over year, outpacing competitors by double digits. The on-premise software and database market is also expected to grow at 12 to 14% annually, providing another avenue for sustained revenue growth.
This leads to our thesis. Although Oracle is experiencing near-term challenges, including revenue projections for the full year 25 falling short of Wall Street expectations and heightened foreign exchange pressures compressing company margins, the business remains a strong buy due to several favorable long-term tailwinds, including
OCI's market share potential
strong competitive moat,
and exemplary management and financials. Our first key driver is OCI growth. While Amazon AWS, Microsoft Azure, and Google Cloud dominate the cloud space, Oracle's underdog OCI is quickly growing. OCI's ability to undercut price compared to AWS, the current market leader, is a marked benefit of the company's optimized suite of hardware and software. Moreover, the transition from on-premise to cloud computing allows Oracle to capitalize on clients that desire greater computational performance. This is a major benefit for Oracle, as cloud computing has higher operating margins of around 44% compared to on-premises margins of 29%. The increasing demand for cloud computing, driven by AI and big data, positions OCI for long-term expansion that Wall Street has not fully acknowledged.
but strong growth in itself isn't enough to sustain long-term success. Fortunately, driven by customer preference and user-friendly product offerings, Oracle's integrated suite of products will enable it to gain market share in a fiercely competitive software environment. Oracle's unique value proposition is that it supports both cloud and on-premise computing for services integration. Customers can have all their software and computing needs under one company, allowing for increased efficiency and cost savings. Furthermore, the Oracle Multi-Cloud Initiative has partnerships with all of the big three hyperscalers, giving customers more flexibility with cloud providers.
Our SWOT analysis highlights Oracle's strengths in database management and cloud computing, alongside opportunities for growth in capturing market share with OCI. However, challenges such as high short-term capex and fierce cloud competition must be overcome to maintain long-term success. Despite these challenges, Oracle's wide competitive moat can shield it from fierce competition and economic downturns. Moving to our third key driver behind our thesis, we believe that investments made by Oracle's management position the company for substantial revenue growth. Management has taken great responsibility in creating shareholder value through increased share buybacks and dividend yields, as seen with the dividend doubling last quarter. Moreover, performing a DuPont analysis highlights Oracle's strong return on equity metrics. With the company's net profit margin increasing, it is evident that management has made a pronounced effort to emphasize margin expansion.
In addition to these favorable points, Oracle's excellent financials highlights the stock's attractiveness. Oracle has consistently maintained strong profits with a gross margin of 71% last quarter. This figure is expected to rise back above 80% as CapEx normalizes and higher revenue growth projections. Despite recent declines due to CapEx and R&D investments, Oracle still boasts an impressive 2.85% free cash flow yield, highlighting its efficiency. This will only further accelerate thanks to the switch from on-premise to high-margin OCI. With $140 billion in assets and a triple B debt rating, Oracle has low interest loans and a solid repayment plan. Earnings are projected to grow at a 15% CAGR over the next 5 years, driven by OCI expansion and underappreciated market tailwinds. Oracle's exemplary financials enable it to generate shareholder value as well as reinvest into the company for future revenue growth.
Beyond financials, Oracle benefits from powerful and overlooked tailwinds that could drive even greater growth with the rise of AI. Oracle is built to take on increasing demand for cloud computation with OCI. Its unique value proposition and competitive pricing will enable Oracle to take more market share from the big three hyperscalers.
Increasing remaining performance obligations thanks to government contracts from Project Stargate can help drive Oracle's revenue growth. Currently, Wall Street hasn't priced in the 500 billion potential contracts from Stargate, which could increase revenue growth between 18 and 20%.
Finally, creating shareholder value through dividends and share buybacks will boost EPS growth faster than revenue and drive the stock price higher. As we've all learned at some point in our lives, no investment is without risks. For Oracle, we've identified key risks and mitigants to ensure the robustness of our final recommendation. First, analyzing the cloud computing space leads us to understand it is highly competitive. However, Oracle has clearly identified its unique value with its pricing structure and easy to use integrated enterprise software.
Additionally, supply chain issues could slow Oracle's ability to build data centers and expand to meet OCI growth. In order to fix this, Oracle could establish a long-term relationship with its suppliers, such as Nvidia, so that it's able to receive hardware allocations first with bulk ordering.
Another risk that can negatively affect free cash flow in the short term is the high capex involved with building these data centers. Investors must understand that although short-term capex might be high, this will only lead to greater revenue growth in the future.
Lastly, the United States is experiencing a strong dollar, which is impacting margins negatively by 50 to 75 basis points on a constant currency basis. While this risk is only short term and should improve in a couple of years, Oracle could employ future pricing contracts to mitigate FX risk.
To ensure our investment opportunity was reasonable given its price, we utilized a discounted cash flow and a comparable company's analysis. For our 10-year DCF, we employed a bear, base, and bull case with the following growth rates and found our intrinsic value to be $251.40.
Furthermore, we compared our analysis by performing a comparable comps valuation. Using the EV to EBITDA and PE ratios of industry peers, we derived an average price target of $248.74, aligning with our DCF valuation. To minimize slight errors in our projection, we had utilized a 15% margin of safety on our calculations. After employing our margin of safety, we reached a final valuation of $213.75, which is a 51.25% upside from the company's current price of $140.
Beyond financial metrics, it's important to note that Oracle is a key social impact leader, making significant progress on its ESG initiatives. For example, 81% of Oracle Cloud runs on renewable energy, and company operations have seen a 47% reduction in emissions since 2020. Additionally, Oracle creates a positive institutional impact, supporting global tech education through initiatives in Africa and India. Lastly, Oracle engages in strong corporate oversight rooted in performance-based executive compensation. The company aptly aligns accountability with an alignment to investor interests.
As we cross the finish line, we want you to understand that Oracle is no longer just a legacy software company, it's a rapidly evolving cloud powerhouse.
With OCI's explosive growth, high margin recurring revenue, and deeply undervalued stock price, we firmly recommend to buy with a price target of $213.75, a 51.25% upside from current levels.
Driving innovative technologies.
Oracle unlocks endless possibilities. Thank you.